What if I told you? Most beginner investors don't fail because the market is too complicated. They fail because of a few simple mistakes that almost everyone makes. Think about that carefully. Every single day, thousands of people decide to start investing. They open an account, deposit their hard-earned money, and take their first step toward building wealth. At first, everything feels exciting. You check your portfolio constantly. You watch videos. You follow trends. You feel like you're finally part of the game, but then something changes. The market drops. A stock you believed in starts going down, or worse. You realize you bought something just because everyone else was buying it. And suddenly, that excitement turns into confusion. And then fear. Here's the truth: nobody tells beginners. The biggest losses in investing don't come from bad luck. They don't come from not having enough money. And they definitely don't come from not being smart enough. They come from making the wrong decisions at the wrong time. And the most dangerous part is this: when you're making these mistakes, they don't feel like mistakes. Buying a stock because it's going up feels smart. Selling when prices fall feels safe. Waiting for the perfect moment feels logical. But in reality, these are the exact actions that destroy wealth over time. Now imagine two beginners. Both start with the same amount of money. Both have access to the same information. But one builds long-term wealth, while the other keeps losing, gets frustrated, and eventually quits. What makes the difference? It's not talent. It's not luck. It's not even timing. It's understanding what not to do. In this video, we're going to uncover the biggest investing mistakes beginners make. The silent mistakes that slowly drain your money without you even realizing it. And more importantly, how you can avoid them, because once you learn this, you're no longer just another beginner. You're someone who actually understands how investing works. Most beginners enter the world of investing with one simple belief: if I pick the right stock, I'll make money. It sounds logical. After all, we constantly hear stories about people who invested early in companies like Apple or Amazon and turned small amounts of money into massive wealth. So naturally, beginners focus all their attention on one thing: finding the next big winner. They spend hours searching for top stocks, watching predictions, and following influencers who claim to know what will go up next. But this is where the problem begins. Because investing is not just about what you buy. It's about how you behave. And most beginners completely underestimate this. Instead of having a clear strategy, they jump from one idea to another. One week, they're investing in tech stocks. The next week, they switch to crypto. Then maybe they try trading. There's no consistency. No long-term thinking. Just constant movement. Another major misunderstanding is believing that being more active leads to better results. Beginners often think successful investors are constantly buying and selling, reacting to every market movement, so they try to do the same. They check prices every hour. They panic when the market dips. They get excited when something suddenly rises. And this leads to emotional decisions. Fear makes them sell too early. Greed makes them buy too late. Over time, this cycle repeats again and again. There's also the illusion of control. Many beginners believe they can predict the market. If they just gather enough information, they think they can find the perfect time to buy low and sell high. But even professional investors with years of experience struggle to do this consistently. The reality is simple. The market is unpredictable in the short term. And when beginners try to outsmart it without experience, they end up hurting their own performance. So the real problem isn't a lack of opportunities, it's a lack of understanding. Most beginners are playing the game without knowing the rules, and that's exactly why they keep losing. Now let's break this down in the simplest way possible. The biggest investing mistakes beginners make are not complicated. In fact, they are very predictable patterns of behavior. Once you understand them, you start seeing them everywhere. The first mistake is trying to time the market. Beginners often wait for the perfect moment to invest. They think they should buy when prices are at the lowest point, and sell when prices are at the highest. But here's the reality: no one can consistently predict when the market will go up or down. not beginners, not experts, and while you're waiting for the perfect moment, the market is already moving. Many people end up missing the best days, which are responsible for a huge portion of long-term returns. The second mistake is chasing trends. You see a stock rising quickly. Everyone is talking about it. Social media is full of success stories. It feels like an opportunity. You can't miss, so you buy. But by the time something becomes popular, it's often already expensive. And when the hype fades, prices drop. This leads to the classic mistake of buying high and selling low. The third mistake is investing without a plan. Imagine starting a journey without knowing your destination. That's what most beginners do. They invest randomly, without clear goals, timelines, or strategies. So when the market moves against them, they don't know what to do. This leads to panic and poor decisions. Another major mistake is letting emotions take control. When the market falls, fear takes over and pushes you to sell. When the market rises, greed takes over and pushes you to buy more. Both reactions are natural, but they are dangerous in investing. Successful investors don't eliminate emotions. They manage them by following a plan. Then there's the issue of diversification. Putting all your money into one stock might feel exciting, but it's risky. If that one investment fails, your entire portfolio suffers. Spreading your money across different investments reduces that risk. And finally, beginners ignore the power of time. They focus on short-term gains instead of long-term growth, but real wealth is built through consistency and patience. It's not about making quick wins. It's about staying in the game long enough for your money to grow. Let's look at a real-world example that perfectly shows how beginner mistakes play out. During the rapid rise of Tesla, millions of new investors entered the market for the first time. They saw the headlines. They saw the massive price increases, and they heard stories of people turning small investments into huge profits. It looked like an easy opportunity, so what did many beginners do? They waited, and then finally bought the stock after it had already gone up significantly. Why? Because it felt safe at that point. Everyone was talking about it. It seemed like a proven winner. But that's exactly where things went wrong. After big rallies, markets often become volatile. Prices don't move in a straight line forever. And when Tesla started experiencing sharp ups and downs, many of these new investors weren't prepared. They had no plan, no long-term strategy, no understanding of volatility. So when the price dropped, even slightly, fear took over. They started thinking, what if it keeps falling? What if I lose everything? And then they sold. This is the classic beginner cycle. Buy when prices are high because of hype. Sell when prices fall because of fear. Now compare that to long-term investors. These are people who believed in the company's growth over time. They didn't invest based on short-term hype. They understood that volatility is normal. So when the price dropped, they didn't panic. They held their position. Some even bought more. And over time, as the company continued to grow, they benefited from that patience. We've seen this pattern before. During the dot-com bubble, investors rushed into internet companies simply because they were trending. Prices skyrocketed. Then the bubble burst. Many beginners lost massive amounts of money because they followed hype instead of strategy. But disciplined investors who focused on strong companies and stayed invested long-term eventually recovered and grew their wealth. The pattern never changes. Only the names do. And the investors who succeed are the ones who learn from it. So what should you actually take away from all of this? The most important lesson is simple. Investing success is not about finding the perfect stock. It's about avoiding the biggest mistakes. Most beginners think they need to be smarter, faster, or better at predicting the market, but that's not true. In reality, successful investing is much more about behavior than intelligence. It's about staying calm when the market moves. It's about sticking to a plan when things don't go your way. And it's about thinking long-term, even when short-term results look uncertain. If you look at investors who have built real wealth over time, they all share a few key habits. They invest consistently instead of trying to time the market. They diversify instead of putting all their money into one place. They focus on long-term growth instead of chasing quick profits. And most importantly, they control their emotions. Because emotions are what destroy most beginner portfolios. Fear makes people sell too early. Greed makes people buy too late. And impatience makes people give up before compounding can do its job. But when you remove emotion and replace it with discipline, everything changes. You start making decisions based on logic, not feelings. You stop reacting to every market movement. You stop chasing trends. And you start focusing on what actually matters: time and consistency. This is where the real power of investing comes in. Not in one lucky trade. Not in timing the market perfectly. But in staying invested long enough for your money to grow. Because over time, even small investments can grow into something significant. That's the advantage most beginners overlook. They think they need to do something big to succeed. But in reality, success comes from doing the small things correctly, over and over again. If you can avoid the major mistakes we talked about in this video, you already have an advantage over most investors in the market. And that alone can make a huge difference in your financial future. If you made it this far, you already understand something most beginners don't. Investing is not about luck. It's not about chasing trends. And it's definitely not about guessing the next big winner. It's about discipline. It's about patience. And it's about avoiding the mistakes that quietly destroy your money over time. Now think about this. Every mistake we covered in this video is something you can avoid starting today. You don't need to wait. You don't need more experience. And you don't need to predict the market. You just need to change how you approach investing. Start thinking long-term instead of short-term. Start building a plan instead of following random ideas. Start controlling your emotions instead of reacting to every market move. Because the truth is, most people never learn this. They keep repeating the same mistakes. They keep losing money. And eventually, they give up on investing altogether. But you don't have to be one of them if you continue learning and apply these principles consistently. You'll start to see a completely different result over time. And that's exactly why this channel exists. Here on The Geeky Investor, we break down complex financial ideas into simple, practical lessons you can actually use. Don't know confusion, no hype, just clear, honest insights to help you build wealth the right way. So, if you want to keep improving your financial knowledge and avoid the mistakes that hold most people back, make sure you subscribe to The Geeky Investor, because the more you understand how money works, the better decisions you'll make, and the closer you get to financial freedom. See you in the next video.